Dante, man, you don't even know. I've totally wrecked my apartment today. My Snapchat looks like I'm the worst person ever. Anyways, alright. Let's talk about risk management. This lesson is really more about risk management and portfolio management together. Like, it's not just about, how to buy your bags and stuff. That's included, but it's also about basically how to balance your whole portfolio. So I like this. This quote is really what risk management is all about. It's, don't put all your eggs in one basket. Now the quote is a terrible quote, but because it doesn't really tell you how many bags to put it in and how many eggs to bag ratio, I suppose. How many eggs to basket ratio or whatever, but it's a good place to start. So I wanted to this picture is Barry Schubert when he asked a question. It was like a month ago or something, and he was like asking how much of your portfolio is in digital currencies, and his poll obviously starts with 0% and then less than 5%, 5 to 10%, and then more than 10%, right? And everyone was like, what are you talking about? Like, we're all in crypto. We're like, where's the 100% option or whatever? And it was just funny seeing that, because it basically shows how much it shows two things. It shows how much people don't really I suppose practice formal risk management, and it also shows like how people like risk management is like there's a rule, and then you have to know when to break the rule as well. So this is very important. But in traditional markets, for example, someone would basically structure the portfolio in such a way that like not every single thing they have is in one basket, if you can put it that way. And so I put up a few examples here of how people try to structure their portfolio. And of course, some of the obvious ones, real estate, precious metals, crypto, some general savings in, currencies that hold value, like dollars and yen or whatever. And then, of course, normie shitcoins. I call them normie shitcoins, but, you get the point. Stocks and bonds and your 401k if you're American. And this is how most people, structure their portfolio, like in general, like people in the institutional world or whatever, they might, even put some money into other things like, whatever. But we're in crypto, so we're going to talk about crypto. This. By the way, guys, you should probably like keep just saying things in the chat so that I know, because it's weird to just talk to yourself. So, you should probably just say something every now and then so I know like everything's going fine. Just say, it's going fine or whatever. So, crypto is like... Okay. Thanks, Fraser. Is that Frager or Frager or Fraser? I don't know. So, in crypto, people tend to just put all their money in one thing at the same time, right? You have, let's say you have, one BTC, your portfolio, your entire portfolio is one Bitcoin. Yeah, it'll get worse. Try first. Um, your entire portfolio is in one coin, or one trade, or one position, or one thing that you're doing, and this is really bad because it kind of sets you up for failure when you try to let's say you found out like this week you're a trader and you put all your money on Bittrex or whatever, and you buy two shit coins and then they all go down and you get wrecked, right? And then you find this new ICO, then you sell everything and then put all your money in that one ICO. That's not how you structure a crypto portfolio. You're gonna get yourself wrecked. So I basically picked out four. By the way, the bars in the chat don't really mean anything. I just put it there for so it looks cool. But when you have most people in crypto have an Excel, Microsoft Excel spreadsheet that they use to calculate their portfolio. When if you don't have if you don't have Coinigy or one of those fancy pie charts, you could just use Excel and put in your portfolio and put in like how much BTC and things and determine how much loss you can take before you have to sell, that kind of stuff. But four main ways to put money in crypto are just your normal trading account, some money into ICOs, some money in passive income, and some money in mining. And we'll go ahead and talk some more about these four segments, if you can call it that. So, let's say you structure your portfolio with those four. Let's call them segments, right? Now, how many percent you put in what is up to you, right? Personally, I'm obviously a trader, so more of my money goes into trading than anything else. But it's up to you. Let's say you're like one of those ICO chasing type dudes. What's that guy called on Twitter? Ian Ballerina or whatever, the Diary of a Made Man guy. He probably has most of his money in ICOs, but I put it 10% because I think ICOs are just not good anymore. But it's up to you to do to figure out how what suits you, what suits your lifestyle, what suits your temperament. But when it comes to this kind of stuff, you want to put your money in different things. And talking about trading specifically, there's obviously there isn't like that many things you can trade in crypto. You can't really trade. I mean, you can in some exchanges, but you can't really trade altcoins with leverage for the most part. But you can get a few options on Finex or BitMEX. You can get some like one or two altcoins that you can trade with leverage. You can long or short them, which is really like the most important thing for margin trading is shorting shitcoins. Because I mean, it's kind of hard to tell when they're gonna go up, but it's easier to tell when they're gonna come down. So that's like the biggest money maker in crypto that no one really looks into. But obviously in trading, four main aspects. You could trade altcoins with or without leverage. You can trade Bitcoin with or without leverage. But passive income is again one of those things that's like really underlooked, and I like Loops's quotes that what staking are for bitches or something like that. It calls people staking ass bitches and things like that. But it's really one of those things you want to do because it kind of gives you like a strong base. Your trading portfolio is going to go up and down, but if you have a master node, right? If you have a Dash master node, if you have a master node for I don't know, some of the like cheaper coins, you can be assured a certain a certain yeah, Dante, we'll talk about, we'll do a Q&A after the slides. I'll answer those questions. But staking is when you buy a coin. So let's say you have waves, for example, you can buy waves on Bittrex, send it to the waves wallet, and just leave it there, right? And basically what this does is, when you know how miners mine coins and you get some, and the miners get the coins. In staking, if you just hold your coins in the wallet, you get some more coins. That's what that is. So you want to put some money into staking, into masternodes. You want to try to show ref links. I mean, people are gonna laugh at you and people are gonna talk, shit about you. But it's a good way to make some extra like cash flow. And of course, the final thing that no one really does in crypto is lending. You could go to Poloniex. You could go to, I think Finex does it as well. I think the new Bittrex is gonna do it. But you can go to Poloniex and Finex, and you could basically lend your money out for a certain percentage a day or a week or whatever, and you can get money. Instead of putting your money in your account and the bank gives you 0.06% APR or whatever, you could put that money in Poloniex and have someone pay you 0.5% or 0.6%. I think it's daily. Personally, I don't do much lending either, but it's a good strategy for people who don't really, you're not a good trader, but you want to make money in crypto. You want to hold a certain value without getting wrecked. And of course, ICOs. If you want to chase ICOs, that's good. Personally, I don't really chase ICOs that much. I put Gambits in there because I know one of the only trading rooms in crypto that's worth anything is the Colin Group Gambit, and they have this thing they do where basically you can get into ICOs in the pre-sale, so that's that's pretty cool. I'm not in the group because I personally I just don't like paid groups or whatever, but I know they do that, and so if you have an avenue like that, that's good. But apart from that, most ICOs are scam. But still, if you want to chase if you want to chase ICOs, that's good. And the final thing that no one does at all anymore is mining. Okay, when I came into crypto in 2015, we used to mine coins all the time. Every single coin was a mining coin. There were no ICOs. Every staking coin was like mining and then staking, right? So every coin was mining. So all the new coins were, you could just go and mine them and get some money, basically. So when there's a coin right now, BCO, right? It's a crypto bridge. It's a decentralized exchange thing. That coin is not an ICO. It's not a staking coin. It's nothing. It's a mining coin. And the reason why they did that is because they know, like most newer guys, don't know how to mine without a rig. They don't know how to mine coins. They don't know where to find coins to mine. They don't know how fast to get in. So very soon in crypto, a lot of coins are going to go away from that staking model or the ICO model because of the SEC and whatever, and they're going to go back to mining. And if you know how to mine coins, you're going to get rich, because that crypto bridge, for example, I know a lot of people who got in like really early, and they've already made some good money, and the coin isn't even popular yet, right? When the coin gets popular, they're gonna make a killing because they've mined some really, really good coins. So that's one other thing that you want to put into your portfolio. Again, how many percent is totally up to you. You have to find what you're good at and do that. So now, when it comes to trading risk management, which is, I suppose, the crux of why we're here, this is probably the most important thing to remember in crypto is the 1% rule, right? Now, I've put a screenshot. The second one is from Investopedia. I don't really know where this one comes from, but it basically what's the Han? Oh, I don't know how to say your names. Sorry if I butchered it, but we'll take Q&A after the slides. So the 1% rule. Now, what this means, I mean, you can read it. It basically tells you that you're not allowed to. If you follow the 1% rule, you shouldn't lose more than 1% in any trade, right? This is what it, like in crypto. Many people think that the 1% rule means that you have to only put 1% of your money in a trade. That's not what it means. What it actually means is that you're not allowed to lose more than 1% of your entire portfolio, or in this case, your trading portfolio. When you hit, like, that should be your stop loss. Is, have I lost 1% of my trading portfolio? Yes. Then you exit the trade. Now, the thing with rules is that all rules are meant to be broken. So when you get better at trading, you're gonna know when to eat a loss and when to follow this rule to the T. Now, of course, there's the 1% rule and the 2% rule and whatever else, and all that stuff is cool. But just remember, the 1% rule is the very bedrock of trading in all of financial trading, right? Not just crypto, everything. The forex guys, the bond guys, they all use it. Okay. There's something called, well, I call it the drawer analogy, and it's called a drawer because I don't know what it's called in America. It's called an organizer or something. So basically, assume you have one BTC, right? Think of that portfolio, that trading portfolio, as an organizer or a drawer, depending on where you're from. Now, and okay, I just noticed this is actually like a bunch of bras, and I'm sorry about that. I didn't know when I stole the picture from Google that it was going to be a bunch of bras. It just looked pretty. These are probably panties too. God damn it. Yeah, ignore that. ignore that. Holy shit. Okay. So, think of your portfolio like a think of it like an organizer, right? You have a bag, and it has 3 sections, 4 sections, 5 sections, 100 sections, and you can put like things into each one of those sections, right? That's what your portfolio. That's how you have to think of your portfolio, is like a drawer or an organizer. So now, let's say you are the kind of guy who likes to put 5% of your portfolio in each trade, right? 5% of your portfolio is obviously 20 sections in your organizer, your drawer. That's now assuming you have 1 BTC. That should come out as 0.05 BTC for each trade maximum. That's how much you put in a single trade, is 0.5 BTC maximum, because that's how an organizer works, right? You can't put more in it than it has to take. Now, when you do that, right, 1% of your drawer is 0.1 BTC. So that means that if you lose 5% on that trade, you have to exit. Now, this is like, in trading, like more important than how much you're going to make is how much you're going to lose. Like that's the first thing you should be thinking about. You should be thinking, how much can I possibly lose in this trade, right? So when you do that, you have to think to yourself, okay, maximum 1% of my portfolio, which is 5% in the case of this 20 section drawer. Now, let's say you're the kind of guy who wants to own every single coin. You're freaking beamish or whatever. You want to own every single coin that is on every single exchange. You want to buy the top 100 coins on coin market cap. This is what your drawer would look like. Just I don't even know how many. So assuming this is 100 slots in your organizer. Now that means is for each trade you have 0.01 BTC, 0.01 BTC, and that's how much you can put maximum in each trade. Now, but this means that that's also your stop loss, right? I mean, you can't have a stop loss that's the same as the size for each trade. So what this means is you can't put more than, like when you put that 0.1 BTC into a trade, you're basically just forgetting it. It's like a spray and pray type of strategy, right? You put it in there and you just forget it. It's like if it pumps, great, I'll take money. If it dumps, you don't care, right? You just put it in there and forget it. Now, of course, there's the final bit of this, which I just wanted to mention. Just a customized split. You have to calculate what the stop loss is for each trade. That's up to you. If you get better as a trader, that's probably what you're gonna use. Me personally, I have bags that are 5% of my portfolio. I have bags that are 10% of my. I have 2 bags that make up 10% of my entire portfolio, and that's the maximum, right? The rest are basically some 5%, some 3%, all the way down to 1%. And the reason why you do this is because if you have like a coin that's like a low market cap coin, it has shitty order books. You can't put your entire portfolio in that one coin, because if you wanted to exit, it would be impossible. You would like have to destroy the entire order book to get out. So that's why you have like some 1% in your portfolios. You just put it in there and you forget about it. If the coin pumps, great. If it doesn't pump, I have a coin, Neutron, that I put in 1% of my portfolio in on coinexchange.com, right? I put it in there in like April. Totally forgot about it. Then I saw some people tweeting about it on Twitter, and I checked it, and the coin was up like 20x, right? And I just sold and took the money and left, right? Because that's how that would work. It's like you put in a percentage of your portfolio and you just forget about it. But some coins you're like, this is gonna be bigger. The market doesn't move that much. So I mean, if you put in like 1% of your portfolio, you're not gonna make that much money on it. So you might decide to go bigger. But this is what this is how you progress as a trader, right? If you're a noob, you should probably stick to the spray and pray strategy, because it's frankly easier to do, and it's probably better for you. But it's very important to remember, I put in here no random shit, right? Just because you have 100 slots to fill doesn't mean you should fill 100 slots, right? You have 100 slots, you find a coin, most times you're going to have 20% of your portfolio in Bitcoin. You're going to have 30%, 40%. Because just because you have 100 slots to fill doesn't mean you should just go in and throw in all that money into, shit coins everywhere. You will get wrecked. So that's important to remember. Because when people start doing this type of, trading, risk management, they end up just doing that. They end up going into, just put in a bunch of shit coins and just forget, and and then they come back later, and they wonder why their portfolio is wrecked, and they have no they when it's time to actually buy the dip, they don't have money to buy the dip, right? And we're gonna talk about how to enter trades next. But if you guys could just say something in the chat, let me know you're still alive and still here. That would be great. By the way, how many people are watching this right now? Because I have no idea. How many views do we have? $27 viewers. Okay, that's good. That's good. Okay, moving on. Okay, 25, 27 is good. I mean, it's okay. It's not like I'm not doing this for the views or whatever. The videos are gonna be private anyways, so it doesn't really. I just want to know if people are still here and still listening. Now, moving on. How do you enter a position? This is a very important thing that most people need to learn. Now, yesterday someone showed me. He posted a link in the TA room in our Slack, and he's like, XLR, XLM, Stellar coin is up like 30%. Man, I think I should buy more, but I don't know what to do. And I'm like, you shouldn't chase coins. If it goes up, just set your order where there's a possible retrace. And he didn't buy the coin, which is good. And then he woke up today, and SLR has gone up 2x, and he's like, oh man, I should have FOMO'd this. I should have I should have bought this in, and whatever. And I'm like, no, like that's not just because what you didn't make you money doesn't mean it's like it was the wrong thing to do. So that's something that you should really remember. A few rules. I wrote a few rules of thumb because I don't even know how the phrase can say rules of thumb or rule of thumb, so I have no idea. So a few rules of thumb, right? Never FOMO something. You shouldn't just buy something because you've seen, it's going up. So you're like, I'm gonna just FOMO this and hopefully it goes up 100% tomorrow. No, don't do that. You will get wrecked. And the reason is because most times, if something is at a place where you can actually FOMO it, it's probably too late. Because just like Ambroid said that tops don't give you time to sell. It's the same thing. Bottoms don't give you time to buy either. I mean, that's actually not that's different. But like, if you actually find it resting at a certain position and giving you time to buy in there, it's probably not the time to buy in. So, but I want you to understand, like, FOMOing is different from like if you've predetermined. Like, if you think, okay, I'm gonna buy this when it breaks new all-time high. I'm gonna buy this when it breaks this, resistance. Sorry, yeah, when it breaks this resistance, and then it does break the resistance or a new all-time high, and then you buy that. That's not FOMOing. Just because you bought something, like you pressed a button and then bought into it, doesn't mean you've FOMOed it. So I think that's a good that's a good thing to clarify. Now, yeah, of course, never chase. Also very important. Yes, Han, you should just that's good. So never chase. Again, crypto has thousands of coins you could buy. If something is pumping, don't chase it. Find something else to go buy. Okay. This is actually the most important thing here. Never enter all at once. if you want to buy something, never never enter your entire portfolio all at once. And we'll talk about that in this section about the 3 or 5 tranche strategy that I wrote down here. So in crypto, every line is a range. If you see someone draw a horizontal support line, that's actually, it's a range, like that general area. It doesn't mean like if it goes down a little bit below the line, then the line is no longer useful or whatever. It's actually a range. So this should like help you enter better when you try to buy a coin. Yeah, Zachar. Most people did that. Like most people were just FOMOing it. I did it as well. Everyone did it. But if you know that's not what to do, then you've immediately become a better trader. So now here's why you should never enter all your positions at once. Just because a resistance or support level exists doesn't mean it's not going to break down. A lot of times they do break down. Like if you have like a position you want to buy at 1,000 satoshis or whatever, it's possible that it's going to break down to 800 or 500 or whatever. Then you're going to be asking yourself, oh man, I hope I should have bought less. I hope I didn't. I wish I bought less. I wish I didn't go in all at the same time. But you also don't want to like not buy anything at all, right? So this is why you want to enter your positions using 2 strategies that I've mentioned here. The 3 or 5 tranche strategy. Tranche is a word that I learned when I was watching that movie about the housing bubble. Yes, Han. That if you predetermined that a new all-time high that you would buy when something hits a new all-time high, and then it does, and you FOMO, then that's not the same as just like FOMOing something because it's going up slightly. If a buy is predetermined, if you've decided before that you're gonna buy it, then you do buy it after it breaks a new all-time high. That's not the same FOMO as just like FOMOing things. So I should probably just keep the questions till after the slides. We'll do a Q&A. You'll ask me whatever you want. Using the trader 5 tranche strategy, I personally use the 3 tranche strategy. What this means is, let's say you want to buy a coin, right? It's a long-term hold for you. You're gonna hold it for like, I don't know, 4 or 5 weeks, or 2 months or whatever. I have bags that are 6 months old. I have bags that are a year. Like I have bags older than Wolf of Poloniex's entire crypto trading career, right? So how you enter a trade is, you see a trade is good, right? It's at your it's at your buy zone. Using the 3 tranche strategy, what you do is you immediately get some, right? If the spread between the buys and the sells are not that much, you can buy some right then. Then you have to decide, where am I going to buy the other 2 tranches of this of this trade. Assuming you have 0.1 BTC for every trade, you then put 300,000 satoshis immediately into that trade. Now you think, where am I going to put the other 600,000 satoshis? Okay, that's when you then decide to use a time-based strategy or a price-based strategy. If you accept that you're going to buy something within the week, right? When you buy the first tranche now, you wait 2-3 days and buy another tranche. The reason why you do this is because it gives you like a general idea of where the price is heading, if it's going up or down or sideways. Now, if you do this often, you're gonna figure like you're gonna realize that you end up with like an average entry position, like an average entry zone. Whereas if you bought like the top of the buy zone, then the coin comes down, to the bottom of the buy zone. Then you're like thinking, "Oh, this is bad. I should have, waited a little bit." But if you use the time-based strategy, you're gonna end up buying somewhere like in like the average of the three buys is gonna be in the middle somehow. Now, the price-based strategy is obvious. Like I'm gonna buy my first tranche here. I'm gonna buy my second tranche. If it goes like 3% or 10% lower, I'm gonna buy my third tranche 10% lower. Personally, if I decide to buy a coin, I use the 5 tranche strategy, right? I'm thinking to myself, this coin is a long-term hold, right? I don't really care about like getting in now and getting out now and making a certain percentage. So what I do is I split the position size into 5 parts, and then I just buy it every time it goes down half of the first one, right? If it goes down half, like if I buy it 1,000 satoshis, I wait, it goes down half to 500 satoshis, I put in the next one, it goes down half to 125, I put in another half, and like that. You end up buying it's like when people say I'm buying all the way down, that's what they mean. That's this price-based strategy. But once again, that's not all that the price-based strategy does. It's like I'm buying at 2,000 satoshis, and I buy some more at 3,000 satoshis, and if it goes up higher at 4,000, then I'm sure of the trend. It's going up, then I'll buy some more, right? Or if you're buying it in a buy zone, you say I'm gonna buy the top of this buy zone, the middle of the buy zone, the bottom of the buy zone. If it breaks below that buy zone and then closes below the buy zone, then I'm gonna exit and call it a loss. That's how you enter a trade. Now, moving on. How do you hodl? A lot of people ask this question like, "Oh man, I wish I could have held some more. I wish I could have held some more." It went up like 2x after I sold. It went up 3x after I sold. Here's how you learn to hodl. First things first. When you structure your portfolio properly, you find out like it's easier to hold a coin. Like if you put 1% of your portfolio, into a coin, if it goes up 2x or 3x, you're not even really gonna notice it, right? Until it goes up 10x, and then you're just like where did all this BTC come from? And now you're gonna find out, oh yeah, this coin has been going up for the last 2 weeks. But if you put 20% of your portfolio in that coin, if it goes up 10% and comes down 8%, then goes up 20%, comes down 8%, those swings are gonna tire you out, right? They're gonna wreck your mindset, and you're gonna end up selling too early. So that's why, like, if you properly build your portfolio, it becomes so much easier to hold coins, because the daily swings don't really lose you that much money. And even if it goes down 8%, you're probably going to buy your next tranche at 8% anyways. So it becomes easier and easier to hold coins. Now, that's what I mean with this second point here. It becomes, if you're averaging down, then downswings don't bother you, right? And if you properly have like when I said Uh, when I said here that like just because you have tranches shouldn't mean you should fill it up with random shit. If you have more BTC waiting, like you have 20% of your portfolio is in Bitcoin. Think of Bitcoin as like the reserve. You know, if you're like a military strategist, you're gonna like when someone fields an army, they put like a reserve somewhere in the bushes just waiting in case you need to apply them to a region that's like breaking or a region that's like being depressed. You put the reserves there. So think of Bitcoin as like your reserve, like your backup, in case something happens. So in general downswings, when all the alts are dying, it's usually because Bitcoin is going up. So if you have like a reasonable percentage of your portfolio in the reserve Bitcoin, then when alts going down, your Bitcoin goes up, and you end up like having like an averaged out portfolio dollar wise, because it's not going to be like you put all your money in alts, now all the alts are down and you've lost money, and if you're even trading some of that like Bitcoin, if you're margin trading it, you're long, right? It's called hedging. When you hedge your altcoin portfolio with a Bitcoin long on BitMEX or Bitfinex or something, then you end up making more money when alts go down. Like your portfolio actually gets bigger when alts go down. So right now, I'm actually I'm long Bitcoin on BitMEX because it looks like I'm bleeding. My alts are bleeding. My alts are getting wrecked, but I'm actually making more money because that long on BitMEX has covered the loss that I've made on my altcoin portfolio. You know what I mean? So, and this leads us to the third point that I mentioned earlier. If you've already decided that you're going to buy more, like you're going to buy your second or third tranche when things go down, then it doesn't really affect you that much psychologically when alts go down, because the whole how to hold a bag is all about like your psychological strength. People call it intestinal fortitude or whatever. You have big balls, your guts are strong, then you're not gonna get shaken by a bag going down 10% or 15%. So if you've already decided, yeah, I'm gonna cut this loss if the bag goes down, if the bag breaks below the buy zone, if the trade is down 25%, then I'm gonna exit, right? When you set up all these structures, it becomes easier. It just holding coins isn't about getting strong. People always say, "Oh, you need to build a stronger hand or whatever." No, you need to build a better portfolio. And when you build a better portfolio, then like a strong hand just comes along. Moving on to exiting portfolio. Now, you've bought your coins. It's going up, hooray! You're thinking about how many Lambos you're gonna get, all the drugs and bitches you're gonna waste that money on. Now you're thinking, how do I exit? Right? You don't want to be that guy who sold, for a 2x and then it goes up 20x, right? Frankly, I'm that guy, right? In the last Ultron, I bought DGB at like 30 satoshis, right? And it went up 3x, and I sold some at 90 satoshis, and I thought, this is good. Coming out of the bear trend, it's been a while since I saw something go up 3x in like that short of a time. Yeah, Dante, just drugs and bitches, man, Lamborghinis and all that. So, you should like think of like how to exit a position. Now, this is very important, right? If you've already grilled into yourself how to enter a position, these tranches that I talked about, I'm going to enter at a 25%, if it goes down 25%, I'm going to enter one tranche. If it goes down another 25%, I'll enter the second tranche, or, whatever like that. That's the same thing as when it goes up. How to exit is like, if it goes up 2x, I'm gonna sell my first tranche. If it goes up 4x, I'll sell my second tranche. If it goes up 20x, I'll sell the third one. If it goes up 100x, I'll sell the last one. Right? That's how you exit. You basically like take the thing you did about entering trades and turn it around into exiting trade. Now, the first bullet point here is sell your first tranche. I didn't spell this correctly. Sell your first tranche at 100% because it helps you when you do that, right? You should always sell like you should always sell your first tranche at 100%, right? Because it reduces your downside risk, right? A lot of people that I know, when a bag goes up 2x, they sell half the bag. And the reason for this is now you've got your money back. You cannot lose on this position anymore. Even if the coin drops 90%, you're still going to make a 10% gain on that trade. And this helps you psychologically, like holding a bag. You know, like I said before, holding a bag is not about like, you know, how long you can hold or something. It's more about like when you've structured your psychological management properly, everything else just comes easy, right? Most of the good traders that I know who hold a bag for 100x are not holding it for 100x because, you know, they are this like strong man with like, you know, freaking Superman arms or whatever. It's because they've structured their portfolio properly, and you know, they buy something for 1%, they forget about it, right? They wake up in 10 months and it's up 100x, and you know, they're like, what the fuck? Then they'll start selling. So exiting positions, again, candlestick patterns, and yeah, we'll talk about this in the next class. And then of course indicators. Personally, I don't use indicators that much, but it's good to use them to decide when not to buy dips and when to start exiting your bags. But you should probably use them less often than like candlestick patterns and charts patterns. And yeah, we'll talk about chart patterns next week when we do our class on TA. So yeah, exiting. Most important thing is to think about entering a trade and then doing the opposite of that, and then using some tools to decide when to exit, and how to exit your bags. I think that's it. Yes, that is it. That is the last slide in this beautiful. Man, the slides started getting like lazier and lazier, and I put in less pictures, but you can see. So let's do a quick Q&A. I think this has been an hour. I think we've been an hour. Yeah. So quick Q&A. I've got links in the description. I've got like a tip jar as well. If you wanted to tip me some money, you can do that too. If you wanted to donate something else, like, you know, some program or something, that'd be great too. But yeah, questions. You guys had questions before, you can ask them now. By the way, tell me how many people are still watching, because I want to know. I think we've probably dropped to like 10 by now. Mr. Sofolix, you can like rewind back to the beginning of the class and start afresh. Thanks, Crypto Noir. Now I know what your real name is. Your real name's Dante, isn't it? You've been doxed, fam. So, ask me questions before I jump out. By the way, people had questions, like they had a bunch of questions about like whatever. I think this Han guy had questions about what is this? Yeah, the like what? How is there a benefit in holding a coin because it's still holding its US value, though its BTC value is down? It's not a benefit. You want more BTC, not more USD. So you know that's it's not. So Traffers asks, what is your buying strategy for upcoming hard fork, or rather, how should we be thinking about it logically? Traffers, this is a good question. Now you should probably it should be easy for you to know what's gonna happen because it's happened before. It happened with Bitcoin Cash. What you should do is very simple. Find an exchange that's gonna do the airdrop, right? Bittrex is probably gonna do the airdrop. Put your BTC on that exchange, or if you can do the whole wallet thing, do that. Hold your own private keys, and when the Segwit 2x client launches, you can upload your coins there. So, one thing is very important: hold those coins. When it comes out, there's gonna be a lot of dumping quickly, but if you want to dump and rebuy, that's gonna be hard for you. So it's easier to just hold them and wait. Now you're probably thinking, how should I know what price to sell? But that's also very simple. At Bitfinex, there's already an exchange for Bitcoin versus the 2x coin. The price there is probably going to be the same as the price of the 2x coins when they actually launch. So that should give you like a general idea of the range. Now, personally, I told you the 1%, the 10% thing that we talked about last class. It's probably going to end up just being 10% of the current Bitcoin value, right? So 0.1 BTC per Segwit 2x coin. That's cool. So that's probably where you're gonna sell. So first things first, hold the coin. Secondly, don't sell until they hit those prices. Fernando says thanks. Thank you, Fernando. Nicola asked me, which coins am I mining now? Which ones are profitable to mine? Am I using NiceHash or mining rig rentals? Well, Nicola, the last coin that I mined is BCO, that crypto bridge that I talked about. I came in late, but I did mine it. I used so if I find a coin really early, I will use NiceHash to get like a really big amount of hash rate just to get in. But after that, you want to use mining rig rentals to sort of hold a stable hash rate for the coins, right? So last thing I mined was crypto bridge. It's too late now. It was too late when I started mining it. Zach's asking, how do I trade? I just told you how I trade, man. What you mean? Red, blue. How do we calculate risk in between BTC and USD? I don't calculate. I'm holding BTC throughout, so there's no like calculation or anything. I trade for more BTC. Even when I trade the BTC USD, I still trade for more BTC. Like, yeah. All right. I think that's it. I'm gonna bail now. If there's more, you should probably ask it quick. If not, I'm gonna bail and see you later. there's no rule. I mean, the last thing we used to think is that if BTC goes up, then alts go down. But during the bull run, they both went up together, and now it's like the relationship is going back to the old ways. So how it goes is really just a general rule is if BTC goes up, alts are going to go down. But then also bounce later, like 2 or 3 days later, they'll just bounce back. So that's all there is. All right, I'm gonna bail. If you have something, ask me on Twitter. Thanks for showing up. Whatever. Peace.